problem that's existing today, that is with banks and with other governments and others, is they own too many treasuries that are losing money.
We are currently sitting in the eye of the storm. While everything may look safe on the surface with housing starts going up, a booming stock market, and low unemployment, we have a wave of economic uncertainty coming in full force. On the surface, everything looks fine. Stocks are doing well. The NASDAQ is up around 43% since the start of the year. The labor market is strong with record low unemployment levels sitting below 4%. And housing starts are getting a new breath, where we've seen a massive jump in new homes being developed for private ownership. But the moment that we take a deeper look into everything, look under the hood, we can see that everything is slowly starting to fall apart, as it has been for the past year. Now, if you look at the Airbnb revenue claims declines by country, you can see that many major cities have fallen in terms of revenue by 40 to even 50%, meaning that while yes, we're getting a surge of supply coming into the housing market, this is going to take quite a bit of time, because creating a home does take time. But losing money happens very fast. And as people are going to be forced out of their homes or forced to sell in these markets and obtain these brand new expensive mortgage rates, it's going to make people lose out on a lot of money. On top of that, it doesn't help that people's savings are quickly depleting. And just based off this chart, it looks like that by the end of September of 2023, which is just a couple of months away, people's savings are going to be depleted from where they were in the post-pandemic era. So not only is revenue falling in the Airbnb space or the housing space, but people's savings are depleting as well. But we also have to understand that whatever happens from the Fed and from an economic standpoint, we need to understand that it takes a lot of time for that to happen. And one thing is that it's a very real fact that the Fed has raised the Fed funds rate at the fastest pace in 4 decades. It makes sense to expect something negative or a negative fallout from that. A soft landing has only been accomplished one time in history in terms of when we're raising rates and avoiding a recession, which was somewhere in the 90s. And to say that we've raised rates the fastest that we ever have in 40 years and to say that we are avoiding a recession now seems very unlikely. Again, you have to remember the yield curve inversion is a massive signal and has been correct for over the last 4 decades in predicting a recession. And as you can see in this chart, typically, whenever we're in the positive, which is right here on the zero, means the economy is expanding. But when it's in the negative, like we are right now, that means the economy is tightening. As you could read right here in the pink, a year ago, both these spreads were positive, showing the upward sloping yield curve. You can see when the economy is expanding. Now they're deeply negative, suggesting a recession is coming soon. Another very important market indicator is the forward spread on the 3-month treasuries. Whenever you're looking 18 months out, this is a good indication of where the markets might be going. Now, what it's predicting is that 18 months from now, that the 3-month spread will be even lower, 1.19% lower than it is now, meaning that they are expecting things to get even worse than they are right now. And like I said before, whenever the Fed, let's say, is raising rates, it takes a lot of time for that to actually play out in the economy. We were raising rates for 10 to 15 months, and then we just started having the banking troubles that we did back in March. So it does take a lot of time. And as the Fed is going to be raising rates in July and most likely in September, we have to ask ourselves, how long is it going to take to play out? And as you can see in this chart, in history, market lows typically arrive 17 to 22 months after the yield curve inverts. This vertical line right here is where we are today. Now, typically it happens within this box. That's when we will see the stock market lows in terms of when the markets will reach their worst points. Now, you can see we're still 10 to about 15 months out until we reach max pain in the stock market, if we're looking and taking a look back at history and prior recessions. So again, it's taking a lot of time. Why? Because that's just how it works out. And a really big reason for this is because with the debt ceiling paused all during the first half of the year, a lot of money went into stocks that would be otherwise committed to going to government bonds. And if you add together the fears of a recession and an artificial intelligence boom, and big tech suddenly looks good. With big tech winning over the growth and the NASDAQ ripping in the first part of the year, people were forgetting about recession fears because they were more worried about making money in the stock market. Now, obviously, another thing leading to this is that how trustworthy is this data that we're getting based on the economy? Obviously, the last thing to go in terms of recession is the labor market. Now, as of right now, the labor market is looking very strong. Currently, as of recording this, it's sitting at a low, a very historic low of 3.7%. But I think one thing we have to remember is that whenever the unemployment rate rises, you could see that it is quite a sharp increase in terms of when it does start to go. It typically takes a while for it to fall back down, but the moment that it starts to rip to the upside, it is a very fast event. But like I mentioned before, how trustworthy is this data actually? Because not only did some states experience large numbers of fraudulent filings with distorted numbers, but the seasonal adjustment factors have changed, sometimes even significantly, because of the lingering effects of the pandemic. And while the pandemic was 3 years ago, there are still effects that are causing things to happen today. And again, remember, since the pandemic began, economic data simply hasn't been as reliable, whether the actual raw numbers or the seasonally adjusted factors. We may therefore be getting a distorted picture of the economy. We may be getting numbers that don't actually represent what's happening, and that's why the economy is looking as good as it does. But when you see headlines like these in the video I made yesterday and videos I've made in the past, you are continuing to see that massive companies are continuing to drop their workforce as UBS is preparing to cut over half of its workforce. And this is supposed to happen as early as July, which is just next month, just a week away. And when you take a look at the initial claims, and just in case you don't know what this is, an initial claim is a claim filed by an unemployed individual after separation from an employer. So while this is the first piece of data that you get in terms of unemployment, because what happens is there's the initial claim, and then weeks later it goes into the unemployment rate because the process takes such a long time. And so as you could see here, from the start of the year in January, we had pretty low initial claims, but since around March we have just continuously rose, and just as of recently we reached some very high highs in terms of initial claims, which means this could push into the unemployment rate here pretty soon. And as we looked in the past, it doesn't take much time for the unemployment rate to rise at a significant rate. So while things might look very dandy on the surface, at the same time, you might be able to think and ask yourself, are we just in the eye of the storm, or has the entire storm already passed? And again, remember how long it takes for economic data to actually come out. It's important to understand where you are in the markets, what's happening, and just how to position yourself in it. Because if we take a look at this recent rip in terms of weekly candles, when you're really talking about recessionary fears and the economy slowing down and indicators showing that we are slowing down in terms of a lot of factors, when you take a look at the NASDAQ and even S&P 500, how many red weeks did we actually have? I mean, right here we had 2 very small red weeks, a third one right here, which was basically just a doji. And just now recently, we're starting to get a small minor pullback. But is this where we start to actually fall in terms of the market? And again, if we take a look back at this chart, maybe our lows haven't been set in. And if we continue to fall down to the downside, we could continuously fall and take out these lows in the NASDAQ and the S&P 500. But again, we're still months away from that even happening. But it's important to understand where we are now, so that way you could set yourself up and position yourself, because the most wealth is always made in terms of recessions. So that's everything I have for this video. I hope you guys found some value in it. I hope you found it helpful. And until the next video, we'll see you guys then.